I'm in Jupiter's office, joined by Ben Whitmore of the Jupiter Global Value Fund. Hi, Ben.
Hello, Heather.
Can we maybe start with the name of the fund? I think most people can work out what the global bit means, but what does value mean to you?
Value can be thought of almost as the opposite of growth. The companies we're looking at tend to have a few issues. They're not growing, or they might be growing slowly. There might be difficulties, and consequently the stock market is very cautious on them, which leads to them being very lowly valued in the stock market.
So does lowly valued just mean that other investors aren't interested in buying that company at the time?
Primarily, the general consensus is that people tend to shy away from companies with issues, where they're not growing so fast, or where they're dealing with an economic downturn, or where things aren't going so well. But the process of that means that those shares can often be very, very lowly valued in the stock market, and hence a good hunting ground for future investment returns.
So you've used this investment approach for a long time in the UK very successfully. What makes you think that you can take this approach and use it on a global stage?
So value as a style of investing has been proven to work over long periods of time in all major markets around the world. It doesn't work every year, but over long periods of time it does work. You get a premium for investing in lowly valued shares. So we fundamentally see the evidence. And then secondly, we've been investing overseas for our UK funds since 2011. So we've got that shorter time period of seeing the benefits of that in action as well.
And obviously being able to invest across the world means you can invest in any one of hundreds of thousands of companies. Does that mean the fund will have a lot of companies in it?
Well, what we tend to think is that you only ever have so many good ideas, and so the fund is likely to have 35 to 45 companies, and what we want to be is as fussy as possible. The companies we're investing in are lowly valued with good balance sheets, and where we think we've got a very out of favour business, but one only temporarily out of favour.
And as I said, you've done this for a long time in the UK. Why is now a good time to do that globally?
So we think now is a good time for investors, because value as a style has had 3 very poor 10-year returns in the last 100 years. The first one was in the Great Depression of America in the 30s. The second one was the tech bubble in the late 1990s. And the third one is now, since the Great Financial Crisis or Recession of 08-09. Financial historians haven't agreed why that's been the case, but relative to growth investing, value investing has done very poorly. We think if the evidence is there to be believed, the next 10 years should be much better than the last 10 years.
And can you give me an example of a company that fits this value approach that you take?
So one example might be Ericsson. It's the world leader in the provision of mobile telephone equipment to companies like Verizon or Vodafone. And there the company made a series of missteps in the last 5 years. They've signed up poor contracts with their customers. They've diversified into areas which are outside their core competency. That has led to a series of problems, profits falling, and the chairman and chief executive leaving. But notwithstanding that, the balance sheet is very strong. They've got a lot of cash. The business is the world-leading market franchise, and what we believe is that if the business is run sensibly, you should make a good investment return from this point, because the people are so nervous about that company.
As a global fund, you can obviously invest wherever you like, but are there any particular areas or countries that you like at the moment?
We try to be led by where we see value. One of those examples at the moment is Japan. There are a lot of companies there where not only the balance sheet's very strong, but the price you have to pay for the companies is very low. They're in stark contrast to some companies in the Western world which have got a lot of borrowings. We're always reading about companies that have borrowed too much money. It's the reverse in Japan. The balance sheets are very strong and the valuations are very low, so that is quite an attractive area for us.
And any areas in particular that you don't find as attractive?
So the one broad area we don't find as attractive is America. The American economy has been very strong compared to a lot of other economies, and the valuations are higher than average. So we do have some investments in America because it's a very broad market. There are always some businesses out of favour, but in general that would be an area we're not so keen on.
Thank you very much, Ben.
Thank you, Heather.